4 ways to tap your home equity, but maybe you shouldn't.
Brian, I'm excited about this show because I hope that we are going to save our folks a lot of heartache. I mean, right now, it is no surprise if you happen to be on the home ownership side of the equation and you've been in a home for longer than a year, odds are you've done pretty well now. You've seen some equity build up, you've seen the value of your home increase, and you've started having these thoughts in your mind about, man, it seems like there's a lot of trapped value in my home. Maybe should I think about a way to go capitalize on that, to go tap into that?
You know, people buy lottery tickets because they love to daydream about what they do if they won the lottery. And we all know that that's a pipe dream.
Yep.
No, but you're not winning the lottery. But it is one of those things where if you actually owned a house pre-2019 or even bought it through 2019, you have made probably an incredible rate of return.
In most parts of the country, that's true.
Because of inflation and other things. So you're sitting on top of equity right now. And just like, there's parts where you'll have an idea when you see it and you say, hey, so I got 6 figures of equity. What should I do with it? And it starts just, you feel like you ought to scratch that itch. We wanted to walk through the 4 different ways that people most commonly access their home equity. But we want to kind of walk you through the pluses, the minuses, and all the things you should think about so you don't end up falling into a trap and actually squander something that should be a blessing to you and your family.
So let's jump right in. The first way that maybe you've heard of or that maybe has kind of like come across your radar, you've got an email on this, is that you can go out and take a home equity loan. You can actually, in addition to the mortgage that you currently carry on your house, you can go take a loan off of the home equity to try to tap into some of that built-in value that you have.
So the theory on these is you're going to be using the equity in your house, borrowing off of that so you can do an improvement on said house.
Sure.
Think about kitchens, bathrooms, master bedroom, an extension or something like that. But here's the reality. And I was so happy when I talked to Daniel. I said, Daniel, here's a risk with all these equity options is people aren't using them actually for the house. They're going out there and they're consolidating debt. They're going out there buying new vehicles. They're doing all the things they shouldn't with their home equity. And sure enough, when we pulled the data, 51% of people are actually using it for outside of the house. That's not good because let us walk you through. This is not expense-free. There's actually a lot of friction costs that go into home equity loans.
And before we even talk about that, let's talk about conceptually, like debt consolidation is something that we hear a lot about. And we've heard a lot about it because of the interest rate environment that we've been in. Interest rates have been super low up until recent. And so people would say, oh, I've got this credit card debt, or I have these student loans, or I have these auto loans. You know what I'm gonna do? I'm gonna take out a home equity line and I'm gonna consolidate that debt into this home equity line, have a lower interest rate. Well, on the surface, the academic problem with that is you're taking something that is unsecured, like most often credit card debt or something like that, and you are using a secured collateralized asset to go guarantee that debt. So if you can't pay your credit card bills, the bad things that can happen to you are fairly limited. If you take out a home equity line and you can no longer pay that, they can come take your house. So now you're in a horrible position where you have traded something that is not secured by something very important to you to now being secured by something that's very important to you. So I don't know that I would use home equity resources as a means for debt consolidation. I know that was a side, but I feel like it's important.
No, but let's talk about the actual numbers of the fact that typically a home equity loan is going to have costs of 2 to 5%. That is cheaper than normal refinancing.
Costs,
yeah,
right?
For closing costs. These are all the friction costs because you got a lot of professionals between the appraisals, the attorneys, and everything else that's involved. And that is cheaper than the typical refinance is 3 to 6%. Yep. So it is a good bit cheaper, but that's still not free. And then even if you get somebody, an enterprising bank might say, hey, we'll roll a lot of those costs in, or we'll absorb those costs. They're going to charge a premium typically on the interest rate. And by the way, while we're talking about interest rates, these are not as cheap as they once were. I mean, now to do a home equity loan, you're paying north of 7% per year. That's getting on up there.
And so let's look at just a very easy case study. Let's take Abby. She's age 30, and let's say that she takes out a $50,000 home equity loan to put a pool in the backyard. This is the thing that she wants to do, this home improvement. The loan is for 5 years at 7.01% interest. That's the current rate on home equity loans. And she pays $990 per month. So essentially, she pulls the equity out of her house. She pays $990 per month on that. At the end of the term, she has a paid-for pull. Now, she's paid more than $50,000. She's paid $50,000 plus the interest on that. Well, her twin sister, Gabby, wants to teach Abby a lesson about compounding interest and how that can actually play to your benefit instead of hurt you. So instead of taking money out of her home equity and paying it back, Gabby just decides to invest $990 per month for 5 years. So in total, Abby paid $59,418 for a pool. Gabby, on the other hand, invests $59,418 just in a diversified portfolio, trying to grow that for the long term. Well, if Gabby lets her dollar sit there, and we assume that she can earn 8% on average, without saving another dime, after only contributing those dollars those 5 years, Gabby would likely have over $800,000 by retirement 35 years in the future. So that seemingly small decision, that seemingly small $900 a month payment could equal almost 7 figures of wealth by the time that you get to retirement.
So that's about a $750,000 difference once you take out the 50. But, and look, that's the incremental decision, the opportunity cost, and that's always going to be something big. But I want to talk about, because I don't want to just throw, mud at these tools, because they did, like most things that get turned into something that's non-productive, there is a value to this.
Sure.
And Bo, I want to put you on the spot before we move to the next one. Before you move to your current house. Now, I don't think you used debt. You actually just paid for it out of cash flow. But I bet this is something that came to me. You had the opportunity, if you had just a storage space in your attic, that you were able to run some electrical.
Yep.
You were able to put some sheetrock up, run some carpet, and all of a sudden your square footage, you added an extra bedroom and you added a square footage. So if it easily, like, what was a multiple 3, 4?
It was
from
big.
what you paid?
Absolutely. Because square footage around here was pretty valuable. So being able to add that was valuable to be able to sell that house.
So where this all went bad on the home equity loan was, first of all, if you look at the 2 siblings that we just did the profile on, if you were not paying it off within that 3 to 5 year period, that's where the opportunity cost is running rampant on you. Because if even you paid attention to the sister that invested this, it was $59,000 on a $50,000 loan. That's a $9,000 operating, risk there, an interest cost there. But as Bo just shared on his home improvement, there is a chance sometimes when you do kitchens, when you do extend square footage on your house, there's actually a return that you get on that. But it's all tied back to what's the why, what's the purpose of taking this money. Make sure it's tied in, because there are chances. I don't like absolute saying you should never, ever, ever do this, because there is a tool here that has purpose. You just better measure twice, cut once to make sure that you're using it appropriately. This is not the tool to use if you're trying to consolidate debt, if you're trying to buy the Escalade. It's not the right use of it.
So home equity loans are often, they're fixed rates, right? You take the loan out, you have a fixed rate. Well, there is another type of way that you can tap into your home equity, and that's known as a home equity line of credit. Rather than having a finite fixed dollar amount that you are borrowing on a new loan, this is kind of like a slush fund. You can use the equity in your home as a slush fund. And Brian, I know in your history, you've done this before. You've taken advantage of this type of tool before.
Yeah, the home equity lines of credits. Banks right now, because let's face it, they're probably licking their chops on all the equity sitting out there in these houses, because it's an easy offer for them to say, hey, look, we'll... because the interest rates on these things are a good bit higher. They can be profitable to the banks to lend you the money, and they'll come out there, and there is so much equity out there. They'll say, you know what? We'll give you a debit card. We'll give you a checkbook. All you have to do is, work with us on this. And it's also a great tool for banks if they want to try to convince you to put more of your savings or maybe your business assets with them. They will use unique tools like this. But the problem is that several things can happen, and I've fallen in this trap, and I don't mind being confessional on this. I was using this as my cash reserves for a while. I thought that this was a great way, since I had a debit card, since I had a checkbook, What could go wrong? I was using this as my emergency reserves, but the problem is, as you guys know, bad news typically comes in. It's an extrovert, and you see it all happen at the same time. Downturns in the market, downturns in the housing, and all of a sudden the banks, and I've had that letter. We didn't pull it up because it's supposed to be a quick in and out Q&A show, but I've actually gotten the Dear John letter from the bank saying, just kidding, you don't get to use that equity anymore. So once again, this is a thing that you've got to be very careful, because on paper it seems bulletproof. But the reality is that you have a variable interest rate. So if you go out there and buy a new car with a home equity loan, and a home equity line of credit, or you try to do this for lifestyle like vacations and other things, there's a chance with this rising interest rate environment that you are actually creating lifestyle decisions that you might be paying for 5 years, 10 years, 15 years, and it seems so simple and easy and innocent in the beginning, but this is the piling on effect of the negative side of debt. Remember, we're trying to get you a rate of return that can compound and work for you. The more debt you take on with rising interest rates, that compounding is actually starting to work against you. So you need to be very careful of that ease of capital and be very aware of the rising interest rates and the variability of these products.
And what I think is so interesting is that most often, at least in my experience, when I've seen people get into troubles with home equity lines of credit, is they say, I don't want to take out a home equity loan. I don't have a finite number that I need. I just want to have access to it. So they say, you know what, I'm going to go to the bank, I'm going to open up this HELOC, and I'm just going to have access. Well, all of a sudden there's a medical bill. Oh, well, I've got the HELOC. Okay, well, I'll do that. Well, okay, well, nah, we're going to do it with that vacation. Well, I don't want to put it on the credit card. I'll just use the home equity line, and then I do that, and then I do that. And then you get into a situation where it is a variable rate, and the rate changes on you, and that change can be substantial. So right now on home equity lines of credit, the interest rate's a little bit better than fixed home equity loans. You can get a home equity line right now somewhere around 6.5%. So at 6.5%, the monthly payment on a HELOC, a home equity line of credit on $50,000 that you are shooting to pay off in 5 years would be $978.54. If, however, that rate adjusted, and we're seeing this happen right now in home equity lines, if the interest rate went up to 10%, which sounds crazy, I know, but it could happen. We've seen rates rise. We don't know where they're going. If it went up to 10%, the new monthly payment required to have that loan satisfied in 5 years would go up to almost $1,100. And while that may not seem like a huge difference on a 1 month basis, take that and extrapolate that over 60 months, and you can see this can get out of hand very, very quickly, especially if you've allowed your home equity line to expand and expand and expand and expand. It is dangerous, dangerous, dangerous territory to get into.
Well, and also realize just a year ago, that $978 payment would have probably been half of that.
Oh, yeah,
because
that's
rates
right.
are up substantially. And Bo, you hit on something. Here's the danger I have with home equity lines. Look, I think in theory, once again, there's nothing wrong with having access to that equity through that debit card, through the checkbook they give you. But what I don't like is it is an impairment to discipline, and the fact that sometimes when you face life decisions, you need to figure out, hey, where can I trim my spending? Where can I look at my lifestyle? How can I make sure that I'm actually finding a solution through this problem
Not the easy path.
Versus just saying, hey, I'll just go pull it from the home equity line. Because that is the problem, is that we are actually building on mistakes instead of them getting fixed because money's tight through that forced scarcity moment. You're actually just using this bridge, this Band-Aid moment. But the problem is that it gets easier and easier. The first time you do this because, like I said, you have a washer and dryer that you need to replace, or you have it's hard, but then you do it. And then the next time you have a vacation come up, you're like, well, it got tight. I'll just go pull it off of that. And before you know it, you've really gotten yourself in a pickle on something that should be so positive for you that you actually have all this equity in your house.
All right, so we've talked about home equity loans. We've talked about home equity line of credits. Another option, another way that you can tap into home equity, and we've seen people do this again over the past couple of years, is you can just do a true mortgage refinance. You can refinance your current mortgage, and you can borrow more than you currently owe. It's called a cash out refinance that ends up putting capital in your pocket.
Well, first, there's a lot of you that you have all this equity in your house, but you're also recognizing, hey, I just got a mortgage rate at once in a lifetime opportunities.
3%
Yeah,
interest.
I mean, you have a 2.5%, 3% mortgage rate. Yes, you have tons of equity you get access to, but the problem is if you go refinance right now, you're going to get a 6% mortgage rate. That does not seem like a good deal. So that's the first problem. But I don't think that this will last forever. I mean, you'll typically the refinance market is pretty much dead right now because of all the increases in price. But it is one of those things that when it comes, I want you to remember this conversation. When that moment comes that you can get access to refinancing, and it's expensive. It's 3 to 6% typically. That's why you don't want to do this a ton. When rates start going down, make sure that it's a big enough drop that it justifies what you're actually absorbing and all the friction costs between the attorneys and all the appraisals and everything else. But my big part with this is that it's when you refinance that you've taken something that's your amortization just keeps getting stretched.
That's what people most often do.
Yeah, we'll see. You have a 30-year mortgage. Let me give you a good example here, because we saw this so many times when the refinancing boom kicks in. You have a 30-year mortgage or a 15-year mortgage. Choose your poison there. You've lived in the house for 10 years. You're getting to that sweet spot that now the loan is starting to really pay down rapidly because your amortization is so much shorter than it was. But then when you refinance, they give you a brand new, freshly minted 360 payment 30-year mortgage. Yes, your payment is lower, but think of how much longer you've reset that timeline to pay it back. So that's why when we do get to where rates are good for refinancing again, here's a nice hack on the refinance game. Take advantage of the lower interest rate. That's a win. That's a good thing. You get to put that in your pocket and then actually turn that into money for your household because you're lowering the cost of lending. However, you need to keep the old amortization.
That's right.
So if you were on a 15-year mortgage, lived in it for just say 7 years, when you refinance into another 15-year mortgage, don't pay it off over 15 years. Pay it off over that 7 to 8 year period of your old mortgage, because that's going to keep it honest on keeping, so you don't just keep spreading out the timeline where all your savings is not actually savings. It's just you being in debt longer.
So don't mishear us. We like refinancing when it makes sense. We actually work with a lot of our clients over the last decade to make sure that they were refinancing their loans, because if you can get a lower interest payment and pay it off over the same schedule, and you're going to be in the house long enough for the interest savings to offset the closing costs, it makes a lot of sense. However, if you're someone refinancing in this market where you're trading a low interest loan for a high interest loan because you want to do a home improvement or because you want to go on a vacation or because you want a new car, you need to understand how costly that can be. Again, let's look at a case study. Let's say that Kimmy and Jimmy each take out a 30-year mortgage for $250,000 at 5% interest. Kimmy pays $1,342 per month over 30 years. So the total that Kimmy will have paid is going to be $483,138. Jimmy, on the other hand, slips into some legal trouble. We don't know what he got into, but he had to get himself out of it. So he does a cash out refi at 7% interest rate 10 years in so that he can get access to $50,000 for some legal bills. So he had been paying it off. He's going to do the cash out. Now, Jimmy is a fan of the show. He listens to the show. These are legal troubles that he got into. So he's going to continue to pay it off on the same schedule. He's not going to fall into the trap that Brian said, where he stretches out the amortization. His new monthly payment to pay it off in the same schedule is going to be $1,961 per month. But what that means is instead of, like Kimmy, only paying $483,000 over the life of the loan, because of this cash out refi, Jimmy now pays $628,000 for the house that he purchased for $250,000.
Yeah, because remember, you're having to pay that higher interest rate on the entire balance, and that creates an opportunity cost. So that's one of those things. If you're in that type of situation with medical bills, legal costs, or something like that, where you had to get access, you might be better served with a home equity. I mean, some type of loan.
That's right.
But that's, remember,
term.
You would be like the majority of Americans if you did it with the equity of your house, because you now risk losing your actual shelter. So you need to do this with like a 3-year payoff. I mean, nobody does that, but that's what you need to be scared, because you've broken the laws of good financial decision making when you have to use home equity for something outside of the house. So you need to do it like you're scared, and you need to get it paid back ASAP so you don't get yourself in a pickle.
All right, Brian, so we've talked about home equity loans, we've talked about home equity lines of credit, and we've talked about mortgage refinancing. Now, here's what I love about the financial industry, the industry in which we work. It is creative, and they come up with new ideas, and they come up with really interesting solutions. And here's what I hate about the financial industry in which we work. They are creative, and they come up with interesting ideas, and because these 3 things we just talked about, home equity loans, HELOCs, and mortgage refinances, have been around forever. But usually, when we see new things happen in the financial markets, new products come along, or perhaps an old product gets repackaged as a new product. And I feel like that's what this 4th category falls into. Another way that you could potentially tap into your home equity is by taking on what's known as a home equity investment.
Yeah, this is a new thing that's kind of come on the scene, where somebody will offer you a sum of money to essentially participate in the rise of value of your equity in the house. This sounds great on paper, but the problem for me is that most Americans think linearly, not exponentially. So you're thinking about, hey, this person's offering me $100,000 for access to 20% of my equity. You know, this is going to be great. What you don't understand, I think about my parents. They bought their house in 1978 for $60,000. And then you fast forward, went through all the high inflation that we had in the late 70s, early 80s. And now this same house is worth $300,000-$400,000. You can see how the exponential growth from $60,000 to $400,000, the 20%, it's very small on $60,000, very large on something like $400,000. And use current prices of houses. Right now, you might do it on your $400,000 or $500,000 house. But then who's to say that house, because of inflation and other rising factors, is not going to be substantially larger? Be careful, because I know in theory you're like, this is just like Shark Tank. You know, somebody's coming in and giving me
kind of what it feels like.
You know, they're coming in, they're going to participate in this with me. But housing goes up. I mean, that's why it's a great inflation hedge as real estate goes up. This is something that it seems desperate in a lot of ways, because you need money. Somebody who has capital is going to come in and do this deal with you. That gives me some hesitation on that, because I think it's very short-term thinking. And I know where success lies is in the long-term financial mindset. And that's why these products they just don't sit well with me.
And be aware that there are going to be other products that come your way. I mean, there are a lot of similarities between these home equity investments and reverse mortgages. They are not the same, but they're kind of like kissing cousins. You got to make sure that you understand, whenever you take advantage of a financial product or whenever you employ a financial strategy, that you really understand the cost. I think the example you gave, Brian, with your parents is a great example. Had they traded away 20% of their equity in the 70s, right now, today, the value of that home, or the value of the home when they sold, it would be astronomical. So understand what you're getting into. We're talking about ways to tap into your home equity and whether or not you should. One of the best antidotes to being able to, one of the best antidotes to having to tap into home equity is just being a really great saver, is following the financial order of operations, is building a healthy reserve where if you need to do a home improvement, you need to buy a car, you need to fill in the blank, you have resources elsewhere that you can use without having to use your home equity, without having to use the value of your house as a last resort to make those things happen.
And I'll add to that, Bo, is because we often see a lot of times, if you go watch on YouTube, passive real estate investing, they'll tell you to use your existing equity to go fund the next deals. We kind of counter that with, look, I don't think you should get into real estate investing until you're in step 8 of the financial order of operations. Go to moneyguy.com/resources to download that free deliverable. We also have learn.moneyguy.com. You can actually buy the full course on the financial order of operations. And the reason that I always say it's step 8 material, it's because you need to have a good financial foundation underneath you. Everything here that we're talking about where you use your equity and go use it on these other purposes. If you don't have money from other sources, that the only place that you have money is tapping your shelter, that comes off as very desperate. And to me, look, I get it. And that's why medical expenses and other things that come up, this sometimes is the last resort that you get into. But that's not where people are tapping this into. As Daniel and I, when we were doing research, we found majority of people are using this for debt consolidation, new cars, things outside of the house completely. It's lifestyle and consumption decisions. And that stuff bothers me because that's what you could really take something that's so valuable to your family and really turn it upside down just because you didn't go check all the other boxes of a good plan. And I know that sounds, because a lot of people say, how dare you try to keep me from getting access to something like the house? And I'm not trying to keep you from having access. I'm just saying, make sure at the time and place that this isn't desperation or accelerating financial decisions before you're ready. Because yes, you could get lucky, just like you can get lucky with a lottery ticket where it all works out, where the economy rises, you don't run into a bad hiccup situation where you get squeezed on liquidity. But there's also a chance that you just lose it. And that's the part that I want to ensure that you're actually on great, stable ground with all your financial decision making.
So you guys may be wondering, why are you guys talking about home equity right now? Why is that something that's on your radar? Because you guys are asking us a question. We love that we get to put together this content, that you guys reach out and say, hey guys, what do you think about this? Or hey, should I do this? Because we like answering your questions, even the tough ones. We really love the tough discussions. So right now, we have the team out on the wings collecting your questions. So if there's something that you want to get our take on, that you want us to weigh in on, that you just want to know how we would approach navigating that financial decision, by all means get in here. Because at the end of the day, our goal here is to help you take your finances to the next level. So with that, I'm going to throw it over to you, Producer Reby.
Let's do this. Yes. All right. We're going to break down some questions for you today. First up is Thorian. He has a question. It says, is doing step 8 of the FOO for purchases, he is doing step 8 of the FOO. Or is that the question? Sorry, I'm reading this weird. Let's start this over. Nate, edit this out. Okay. Is doing step 8 of the FOO for purchases such as saving for a car or a new HVAC system, and is it okay to do that before step 6 to avoid new debt if starting your financial journey young? He's only 24. So step 8 is where you might naturally say, yeah, save for those things here. But what if you need to do it earlier?
Yeah, so step 8, Brian, that's prepaid future expenses, one of the things that we talk about. And we're often talking about future expenses like college or like that sort of thing. It's interesting because I think Thorian is asking about something different, right? Like not a future expense that I know is coming, like college, but it's more the unknown stuff. Hey, what about when I have to replace my car? What about when I have to replace my HVAC? And I think a lot of people assume that as I'm on what I call the FOO path, I just dubbed that, TM. As I'm on the FOO path, I can't ever go backwards. Once I'm charging forward, I can't ever step back. What are your thoughts on that? What would you say to Thorian about that?
Believe me, the whole financial order operation is supposed to be dynamic, where, of course, I mean, if you have life changes where you get a huge pay raise or even you get a pay cut or you lose your job, it's not uncommon that you might have to go look at and analyze, where am I at, and recalibrate on the financial order of operations. Because, and let me just do a quick review. Step 6, max out retirement.
Hold it up. Show it to them. Tell them where they can get it.
Step 6 is moneyguy.com/resources. Go check it out, or go to learn.moneyguy.com for the full course. But step 6 is max out retirement. What that means is you're saving and investing 25% of your gross income towards the future. So graduating from that, you get to step 7, which is hyperaccumulation, which is the 3 bucket strategy we talk about in step 8, is prepaid future expenses. So I've just covered the 6, 7, and 8, but the things he brought up was cars, and then replacing the AC in your house. Cars, when I think of step 8, and cars, I'm thinking this is the point you've graduated to. You want a Tesla,
The luxury
or you want a
brand, the
luxury
nice one, yeah.
vehicle, not for something to give you dependable transportation to work, because that falls back more towards step 4, which is the emergency reserves. So, and I think, by the way, we live in the South. So AC definitely falls into emergency category, that you better make sure you have AC here in the summer or you're in trouble.
Yep.
I mean, and that comes to, ask Daniel about a car that didn't have AC. I think that was one of the first things he was trying to get fixed, because that rolling the windows down doesn't work when it's 100 degrees outside with high humidity. So that's what I would bring it back to, things like replacing the AC on your house, or things like trying to have a car that's dependable that you can get to work. That falls back to 23.8, which that 20% down payment, that's the 20 of the 23.8 on the car, 20% down, don't finance for longer than 3 years, 8% of your gross income to the debt payments. Is that should come out of step 4, the emergency reserves. Because both of these things you mentioned, getting to work so you can have your most valuable income producing thing that you can use discipline to turn into resources and assets for the long term, is going to come from emergency reserves, replacing the air conditioner, emergency reserves. Because remember, you're supposed to be keeping 3 to 6 months there. Don't get off track with clouding up what's a need versus a want. And I got to tell you, having dependable transportation, that's a need. You got to have that to get to work, to pay for yourself. Having AC, that's a need. That's not a want. So those things need to be prioritized.
And look, I'll be confessional here. A couple times over the last 5 years, or over the last 5 years, I've had to adjust what I'm doing to the food. You know, when my wife and I were building our new house, we had not sold our old house yet. So we kind of had to do the 2-home thing for a while. As you can imagine, that makes, if you're not selling your current house and you have to put a down payment on the new house, you might have to make some adjustments. Brian, when you and I bought a commercial building, you got to come up with money to be able to do that. You have to kind of figure out how to tweak. The FOO is supposed to give you an idea of what to do with your next dollar when you don't know what to do with your next dollar. But when you got, just like you said, when you have one of those needs, like I need an HVAC or I need a car, make sure if you back away from the FOO, you have some scaredness in your soul that gets you back on that path as quickly as possible so that you can get all the ships moving back in the right direction.
Awesome. And remember, if you need a refresher on what the 9 steps of the financial order of operations, or the FOO, is, just run to moneyguide.com/resources, or you can get the deep dive in our course at learn.moneyguide.com. Okay. Joshua has a question. Do you think you all could speak to no penalty CDs? Given the market volatility and interest rate, would these be a good place to store cash, or even an emergency fund? I think this probably echoes a lot of people wondering about the volatility right now. So what do you guys think about CDs as an option, and what you should be doing with your money right now?
Well, it's really interesting. CDs, right? Certificates of deposit, all cash holdings, for the past couple of years have kind of been getting a cruddy name, right? Like yields have been super low. You've not been making a ton on cash. But now we are getting into an environment where some of those cash instruments, whether it be high yield money markets or CDs or fill in the blank on cash or sort of cash equivalents, are starting to become more attractive. So I think a lot of people are asking the question, how should I be utilizing these? Should I be thinking about these? Where do they fit in to the plan? And is it something I ought to be investigating?
Well, the whole no penalty is a whole nother angle, but let me just talk about CDs versus just using FDIC insured money markets. I've seen now that some of the online banks are offering 3% CDs, and you're like, woo, 3%? When's the last time I saw 3%? But here's the reality of the situation. If you look at what the Federal Reserve, and they're raising interest rates, the environment that they're doing every month, they're just ringing the bell, they're pulling the lever. You have to ask yourself, if they're offering me 3%, can I promise myself in 2 months or 3 months from now that maybe my money market's not already just paying me greater than 3%? And then I'd be pretty sad that I locked in 3% on that CD. Now, look, I know you say there's no penalty on this, so supposedly, but you need to go read the fine print on that, because you still might be forfeiting something, or there's probably something to have some strings attached to it in some way. But that's why I actually like really paying attention to the money markets, these FDIC insured money markets that are at these online banks. The one that I get nothing for telling you guys this, but it's one I use personally is like Ally. Ally has done I've noticed that the Federal Reserve met last week. They raised rates 75 basis points. Guess what I got 2 days later was, now they didn't give me 75 basis points, but Ally did send me an email saying, guess what? Your rate's going up again. I think we're up to 2.1% now on that, and I wouldn't be surprised in the next 2 weeks because they seem to like, maybe they're on this hedonic treadmill type thing of really spreading out my interest rate increases because it feels good. But I love that they're at least proactive, whereas unfortunately the brick and mortar banks, I think they're still paying like 25 basis points or 0.25% or 0.3. And that's very frustrating. I know we love the actual relationship we have with our brick and mortar banks when we have business needs or other things, but they're always struggling to keep pace with the online FDIC insured banks on getting that maximum yield with your cash reserves. So that's that. Hopefully, I've given some context there that helps Joshua out. Bo, what did I leave any meat on the bone?
Let me ask you another question. So, what if somebody's out there saying, "Shoot, Brian, I 3% on a CD, I can go do that. I've been putting money in my 401k this year, and I'm down like 25%. Maybe I should just do this CD thing, this 3% thing." And forget about this stock market thing. Maybe that's not something I ought to be doing. What would your answer to that be?
And look, that's a whole nother question, but it is one of those things where I think it's very important that it feels so comfortable being cash. I get that. It feels like you've stopped the pain, but recognize markets make money 80% of the time. That means 8 out of 10 years, which is unfortunately in that 20% where it feels rough and it hurts. And this is the whole part of investing that's not fun. If we didn't have this 20%, everybody would be like, hey, let's go lock it in and get that annualized 10 to 11%, depending upon how long and how far back you want to start the calculation. That doesn't work. We know long term, we'll get back to normalized because the economy is innovating, it's growing. This is a great thing about the long-term investment concept, but you don't get to say long-term concept unless you're actually locking that money up for the 5 to 7 years. But I do want to caution people, if it is long-term in intent, don't go for the comfort of cash just because in the short term it's going to emotionally make you feel better. If it's got a need that's long-term based, have a big picture. Think about what this money is needed for. Now, I'm kind of counting on you're using these cash reserves or this financial, when we're talking about cash, this is steps 1 and steps 4 of your financial order of operations, which is your deductibles covered if you're just at the beginning of your journey, cash reserves, which is at 3 to 6 months. It can be longer if you're closer to retirement, but that's the money just to protect you on the rainy days. It's not, you got to be careful once your money gets over 6 months, unless you're retired or have a purpose for it. You want to make sure you're not getting eaten alive by inflation, because yes, I know this, the risk of the equity markets feels horrible because it feels like it's just gobbling up your investment all day long. But there's actually a bigger risk with cash in the long term, just because the equities they'll come back. I mean, I'm not worried about that. You just have to build the fortitude emotionally to make it through the rough patch.
Love it.
Awesome. Thanks so much for your question, Joshua. All right, Ryan has a question. He says, I'm in my mid-30s with a pension that covers 60% of my retirement. Would I be better off to focus putting my money into Roth vehicles to better control my tax bracket in retirement and minimize RMDs? What do you think?
So his mid-30s, Ryan, so we know he's young. He did not tell us what his income was, did he?
Did not.
So he said, hey, pensions are great. It's like a guaranteed income stream in retirement, and not a lot of us get those. I mean, all of us have this thought of we're going to have Social Security. That's like a type of pension. But the actual pensions where it says, hey, we're going to replace 60% of your salary, that's huge. That is a financial tool in your tool belt that most people don't get. That is a huge benefit, assuming that you're with a company or an entity that's going to be able to satisfy that for the remainder of your life. So then the question becomes, all right, if I've got that piece solved for, if I've got that piece in there, should I focus on Roth? Should I really build up my Roth bucket? And I think the answer to that question depends a little bit on your current circumstances right now, as well as what do you think later in life is going to look like. If you're Ryan, someone that's in your mid-30s, you've got this pension, you're a lower income, meaning between your federal and your state marginal tax bracket, you're below 25%, I say by all means load up the Roth, because that money's going to grow tax-free for you. So when you have that pension coming in, that's going to be ordinary income to you. Then you can pull off those Roth dollars to subsidize that. And at age 72, there's no required minimum distributions. On the flip side of that, however, if you're someone who's in a higher tax bracket, maybe you're a single individual and you're in a high tax state, and so you're paying like 30% and above, it's really, really hard to walk away from the current year tax benefit and do pre-tax contributions to build up your pre-tax bucket. And then with the tax savings that you garner from that, you could look at either building up an after-tax brokerage account, especially if you're someone who's going to retire early or maybe leave the workforce before you can draw the pension or before you reach age 59 and a half. Or if you have the right account structure, maybe you could even build Roth dollars that way by doing backdoor Roths, doing a non-deductible IRA contribution, and then implementing a Roth conversion strategy over time.
I mean, my thoughts, when in doubt, always just check out with the financial order of operations. It's so easy if you just go to moneyguy.com/resources. There's a reason step 5. The first really, because if we tried to look at the financial order of operations and say, where do investments actually live? Step 2 is, of course, employer match. That's easy because we know that's free money that your employer's putting in, usually getting a 50 to 100% guaranteed rate of return. By the way they're structured. Well, you have a pension. I guarantee you, your employer is probably putting in somewhere between 8 to 14% of your income into a pension plan on your benefit. That's happening automatic without you having to do it.
Yep.
So step 2 has already been satisfied. You didn't have to put anything in. They're just doing that because that's the way they're structured. It's probably a government entity, a school teacher, or some other type of government organization you're working for. So you're a person in your 30s, meaning that you at least got 20 plus years before you retire. You notice the next stop on the investment train is step 5, which is Roth and HSAs. Roth assets for a 30-something are tremendously valuable because you have tons of time on your side for that money, for the compounding growth to build over time. So without a doubt, I think somebody in your situation, I don't know what your income, but if you're, that's always the trade-off if you're working for a government entity, you probably are within the Roth contribution threshold. So we don't know your numbers, but I'm playing that whole deductibility, deducing what your situation is. And I bet you can do Roth IRAs based on that big pension that you got building in the background. I think there's nothing wrong. And also, don't overlook the HSA. There might be an opportunity for you to build that up too, and that's a tax-free planning opportunity. Don't leave that money sitting on the table. It's a great choice, and that's why, when in doubt, refer to the financial order of operations. We've tried to build that into the structure and the plan so that you can be as efficient as possible with your next dollar.
Great. Okay, let's talk about being in your 40s. PokerStar75 says that he and his wife they have a net worth of $3 million plus. So, they're hitting that phase of life where they're starting to think about what's next. He is in his mid 40s. Their teenage kids' college accounts are funded. So that's their situation. Should we look into long-term care insurance? What should we look for when looking for a policy? And what do you guys think about, is this a good next, backstop to put in place for where he is in life?
So for those of you that don't know, long-term care insurance is exactly what it sounds like. It is an insurance that you could pay for now that should you at some point in the future need nursing home care, skilled nursing care, some sort of advanced care in order to provide for you, then the insurance policy will pay to help cover the costs of those. And they're structured a number of different ways, a number of different benefits, a number of different benefit periods, but that's really what it is. If you think that you're going to need help later in life, you buy a long-term care insurance policy to help pay benefits to cover those costs. So the question that he's asking is, hey, should I do that? Or when do I do it? Or how do I know if it makes sense, especially if I'm in a really good financial situation?
Yeah, I think I love, this is one of those, maximizing, and that's what I love about what we do as Financial Mutants, is we kind of help you. It's not just to get by with the minimum, it's actually to help you maximize both from what happens financially, but also from a peace of mind situation. And I think about just and look, PokerStar, we don't sell insurance, but I'm going to give you some thoughts over my 20 plus year financial planning. Back, I mean, what was it, decade, 15 years ago, everybody and their brother was trying to sell long-term care. I mean, you had a gazillion insurance companies, and the problem is they were all rushing to get to market because we all knew this whole graying of the United States.
Living longer.
Everybody's living longer. There's going to be great opportunity here. So everybody got into that marketplace, but I got to tell you, it's been somewhat of a little bit of a, I was going to say disaster, but I mean, I have to be careful how we structure it, because what I've seen is all the policies from that era, they've had to come back, and because there's always a little asterisk when you sign these policies, where they get to go to the insurance commissioner and they can ask where they can raise rates on everybody who's in that contract. So we've seen that for a lot of our clients, is that, all of a sudden the premiums have gone up on everybody.
And they can go up substantially.
But look, the industry's tried to recalibrate, because there used to be a gazillion people in this space, and they mispriced it. Now, if you look at the long-term care space, there's a much smaller group of providers. But they've actually tried to do a better job of underwriting and figuring out what the true cost of this is. But what I've seen when I've looked at policies recently is that instead of giving you these blanket lifetime benefits, they've now tried to compress down to where it's like a 5-year benefit, if you really did need it. So I'm giving you enough here so you can figure out, but this is what I tell clients. You have to really analyze yourself and say, what is the purpose of this insurance? Because I know an insurance broker who's super successful. He doesn't have long-term care on himself. But then I have other clients, and I might fall into this category, is that, if you have created tremendous success for yourself financially, and now you're just trying to make sure it's not about building wealth, it's about keeping your wealth. You might say, hey, I would get a lot of peace of mind. I know I'm paying a premium for this, but I get a lot of peace of mind because that's one more thing I can check the box off of and know I don't ever have to worry about that for my family. There is some value in that. And that's what I've tried to walk with clients to figure out. What's the cost versus the benefit? And a lot of this benefit is do you get to keep your wealth? And we used to talk about the donut method with long-term care, and the fact that if you were your liquid investments were worth less than $1 million, more than likely you're pretty close to the social safety net. If you're worth over $3 million, which, by the way, and maybe that's indexed where we need to say it's higher than $3 million, but in the past it was $3 million. You're kind of at that self-insure stage of life. So really long-term care in the past was for those people, because it's not cheap, who were between that 1 to 3 million, who were looking to protect what they had built, but it wasn't so big that they could self-insure yet. Maybe that number has been expanded out a little bit because things are expensive, but I think you have to balance that with, hey, the benefits typically now are within 5 years. Well, that lends itself more to self-insuring. So what I'll bring it back to is analyze within yourself what's the why on this. And then I don't know if this still holds up, Bo, but in the past it was in your early 50s was the kind of an ideal time to do the underwriting. You actually did insurance, so maybe I'll let you kind of talk about that.
The products have changed a little bit. They used to have annual premiums that you pay. Now they even have products where you can do a single premium where you just put a pot of money in there and it covers you. One of the things I think that you didn't mention that I would think about is look at your family genealogy, right?
Yeah.
When you look at the lives of your parents, grandparents, aunts, uncles, what does end of life commonly look like? Is it, a massive cardiac event and that's it? Or do you have instances of dementia, Alzheimer's, that sort of thing that might lend itself to needing this kind of care? So that's one of the decisions you make around whether, okay, yes, it seems likely I should buy this high probability, or not likely. I love that you talked about being self-insured, because if PokerStar in their 40s is worth like $3 million, and we know that like every 7 years your money can double, then like by his 50s he's approaching like $6 million if he's not saving anymore. And then by his 60s, he's approaching like $12 million. There's a really good chance, based on your standard of living, based on your lifestyle, even if you go factor in the cost of end-of-life care, the cost of nursing home care, the cost of skilled nursing, you'll still be self-insured. this is one of the things that's really, really hard to do in generality. So I would encourage you, Poker Star, if this is something you're seriously considering, this might be one of those times where it makes sense to think about taking the relationship to the next level. Because the answer to should you buy this is no longer rule of thumb. It's more about your unique and your specific situation to determine, does this solve some problem that I have? Does this fit into the overall financial plan that I need? And is now the right time to do it? Or is it something that happens in my early 50s, in my mid 50s? So it might not be a horrible time to think about taking the relationship to the next level.
And I don't want to belabor this, but I think it's so interesting how creative the financial marketplace is because there's also new products on the scene that I know we've looked at for some clients where they are long-term care, but it's structured with these communities where you buy or structured as, I don't know if you want to call it you're leasing or you're buying, because it's an all-in-one package where you're essentially buying into this community where you live in this community and there's different price points depending on what you're getting. But then it's a one-time what you pay in, and then you have some annual maintenance. But it's all tied in.
It's like a country club for later in life.
Yeah, but it's already built into the agreement that as you go from independent living to assisted living to full on, you've got somebody where you're in an actual like hospice or something like that. It's all built into the structure of these things. There's all these new creative things that are coming on the scene that you just want to make sure that you're coordinating all those things. That's right. Because you'd feel bad if this is where you wanted to go, but you're locked in with this. So just make sure. That's why I do like the thought of it might make sense, because I tell you all the time, you can try to keep your life as simple as possible, but success creates complexity. This is one of those things where taking the relationship to the next level might add just another person who's been there, done that. I mean, I love that we actually have one of our planners. He comes from a public accounting background, but he also comes from a background where this is the type of communities that he was working on, how they structure those deals. And that's priceless, because you're doing this for the first time ever and you're trying not to screw it up. Why not talk to somebody who's done this a bunch of times? That's right. So that you actually know what to look for and what's coming your way, so you don't get blindsided by it. But these are heavy decisions that you just need to make sure you're measuring twice on, cutting once, and doing it right.
Fantastic. Thanks for reading the chat, and thanks for your question today, Poker Star. If you are interested in just seeing what it looks like to take the relationship to the next level, head to aboundwealth.com and you can fill out a form there and just learn more about the financial planning services. All right. Ready for an early retirement question?
Love it.
Sure.
Chris says, I'm 37 and married. I'm maxing out my 401k as well as our Roth IRAs, and I'm seriously wanting to cut down on working or maybe even retire in our early 50s. So as he's thinking about this, he asks, which financial milestone would I need to reach in order to achieve this?
It sounds to me like Chris needs to know his number, right? He's 37 and he's married and he maxes his 401k and he maxes. By the way, y'all, I get some flack for repeating the question. It's because I'm making sure I heard it right.
Yeah, you got to get the details right.
That's just active listening for all of you trolls out there. So 37, married, maxes 401k, maxes Roth, looking to retire in his early 50s, and he's looking for some benchmarks, right? He's looking to figure, okay, how do I know if I can do this? And I imagine the question he's asking, Brian, is a lot of people think, okay, when I hit $1 million, then can I retire? Or when I hit $2 million, then can I retire? Did he say if he had kids or anything?
He did not.
He didn't say, when my kids get out of the house, then can I retire? What are some of the ways that when we work with clients, we work with individuals, we help them know, okay, yes, this is when we can sign off, you can leave the workforce. And if early retirement is that thing, there's how we know we have a high level of confidence you can do it early.
Well, yeah. I mean, when we created the financial order of operations, we did 25% because we know if you do that pretty much all the way into your 40s, you're going to be able to have a decent retirement.
Yep.
But I will tell you that this whole new thing, well, it's not new, because this concept of retiring early, or at least having financial independence early, has been around for a long time. I mean, even myself, when I first got into probably in my 20s, if you'd asked me, I said I wanted to be financially independent and just quit working because I want to be a school teacher when I was 50. to 55.
Ooh, 50.
But come on, I'm already running one of the largest online classrooms, so you don't have to worry. I'm not going anywhere because I just somehow built this content empire that allows me to teach a lot more people than if I went to and retired into a classroom. But it is one of those things where I think when you are trying to create a unique goal of you want to be independent at a much earlier age than what the traditional person is out there doing, then you need to be thinking, I'm going well beyond 25%. You're going to 30, you're going to 40, even potentially 50% savings and investment rates of your based on your gross income. So, but I hate to tell you that and then not give you some type of tool or metric that tells you you're doing it right, because what I don't want you to do is you set up this aggressive goal of saving 40 to 50% of your gross income, and then you wake up and you're my age, getting close to 50, and you go, man, I didn't go on enough vacations. You know, I got all this big pot of money. If somebody would just given me some feedback on where I was in this whole journey on what I was actually shooting for, I could have maybe enjoyed life a little bit more. Because that's what I want you, being a financial mutant, maximize not only building wealth, but also building the best version of yourself financially and life version of yourself. So when you are older, you have a sentimental, you're very sentimental and can be, because it happens naturally when you're in your 40s. I was trading emails, one of my clients who's a year older than me, and we were just talking about it because he's even sent me, how many times do clients send you poems, Bo, that they carry around in their pockets? You know, this is the great stuff that's out there. You know, when you get to be in this stage, but I don't want you to have regrets. And that's why, you know, look, we try to, because I had somebody posted a comment over the weekend, said, I hate it when you guys have products because it feels like a grift. I'm like, we're not doing this to be a grift. I mean, we're doing this because I actually see a need that we can't meet. Every person who watches the show might be wondering, what's my number? You know your number was born out of the fact that I think a lot of people out there are trying to figure out, what am I saving for so I can do it the right way, so that I can make sure I'm not overshooting the goal. So I get there and go, man, I should have done more vacations. I should have built more memories with the family. But I also don't want you to YOLO this thing out to where you get to 50 years old and you're like, man, I thought I was going to have more than this at this point. I guess I'm working until I'm 70. There's got to be a balance there. And that's why if you go to learn.moneyguy.com, we do have a brand new course and tool out right now called Know Your Number. And I think it would be tremendously valuable. And plus, for the people who say grift, where do y'all think, we have 6 people on staff writing this content. We want to hire 2 more. Where do y'all think that comes? I love giving away tons of free advice. As I told you, I was trying to retire early so I could be a school teacher. But I've realized we touch millions of people every month with this content, but it's not like it's free. I mean, that's why I'm like, people who want us to give them free, and I love giving away. I love the abundance cycle and giving away tons of free stuff, but stuff does cost things. Sure. I mean, if I had somebody who made cookies for me that I loved, and they brought me cookies once a week, I'd be like, man, it is so great that they bring me cookies. But at some point, I think you'd start feeling guilty. Like, I'd at least buy them some sugar and flour. I mean, seriously. I mean, don't you think that would probably come into the equation at some point? If Brian and Bo are showing up with a plate of cookies every week, well, at some point, let's pitch in for the sugar and flour.
I love it. What I love about answering this question of like, how do I know when? So knowing your number is one piece of it, but then. So early on, you got to know your savings rate. And then as you're developing your savings rate, then you got to know your number. Well, then as you start approaching your number, you got to answer the question, okay, does this work? And that's one of the things that we love helping our clients with, by helping them figure, okay, what am I going to spend in retirement? What are my living expenses going to be? How often am I going to replace cars? What's my travel budget going to look like? If I'm retiring in my 50s, how am I going to pay for insurance until I get to 65? And then what happens at 72 when I have to start taking required minimum distributions? And what if we have more investment years like 2022? Well, before we sign off and say, hey, yes, you are at the point where you can retire, we want to stress test all that. We want to run all that through a Monte Carlo simulation to adjust the variables to see what is the probability of success that you can actually leave the workforce. And frankly, one of my favorite things in the entire world to do, and I had the chance to do this 2 weeks ago. I was meeting with a lady who unfortunately her husband passed away, and she was like, I'm in a bad spot. I'm not gonna be able to make it. And so we did a retirement analysis and we adjusted the variables and worked through it. And I said, hey, I know you're worried. You're gonna be fine. you're going to be able to leave. You're going to be able to retire. The thing that you did not think was possible is still, in fact, possible. And we have the analytics and the data to show that. But before you get there, Chris, you have to make sure that you work through the exercise. What am I going to spend? What's retirement going to look like? What variables can I know? Can I account for? And what are the unknown unknowables that I need to stress test against to make sure that I can make this over the long term? I think it's a fun place to be at 37. And kudos to you for already thinking through, okay, what does this look like? How do I know if I'm moving in the right direction? The fact that you're already maxing out your 401k, already maxing out your Roth, you're doing a lot of the stuff that you ought to be doing. And I'm excited to hear from you in the near future, hopefully.
For sure. Chris, I'm starting this messy middle, know your number thing too, and it's really fascinating. So if any of you guys are interested in jumping into that course and learning what your number is, just go to learn.moneyguy.com. And if you're watching this before October 11th, you could get 20% off. So I just have to throw that in there. That's happening right now. So you can take advantage and then invest that difference and, just be closer to your retirement.
How do you get that 20% off?
Oh, you use the code countdown.
There we go.
But if you go to learn.moneyguy.com, it's all right there. I'll tell you. Use the code countdown at checkout, all that stuff.
Before you go to the next question,
Yeah.
I want to give Bo enough time to come up with fodder and picking on the old man on the board. I'm going to answer one more question, and then I'm taking a restroom break.
No.
Quit. I wanted. Look, I know this
In the
is what
middle
I
of a
wanted.
live stream?
But Bo, this is a long show day. I know we have to answer like 11 questions, and I don't want to. I want to give you enough time to pick on me.
Brian,
Here we go.
There are literally 432,000
I know.
people.
That's why I'm
in
giving
this
you a head
thread
start
right now.
because I'm going to answer one more question, then I'm doing what us late 40 guys
But then
have
you're
to
going
do.
to come back, right?
Yeah, I'm coming back.
Okay, just
I'm
making
coming back.
sure.
Oh,
Okay,
wow.
cool.
You never know what I'm going to
You're
say.
literally about to take a potty break in the middle of the show.
Well, I
Well-
didn't feel like because we got to cut these up and we have to have edits. I didn't feel like it'd be good if I just disappeared.
All right.
Fair
That
enough.
would actually have been great. He just stands up, walks out, comes back on.
Well,
Wow.
we'll give this a nice clean edit. So
All right.
Brian is
Yeah.
in
All right,
the highlight
all right.
clip later.
But you want to answer one more question before
Yeah,
you go?
one more question
Okay.
because
All
I still
right.
got enough reserves. We can make
Buddy,
one more question.
You better believe I'm about to be so long-winded on this question. Oh, man, I'm going to drag this one out.
Okay. Alrighty. Here's your next question. TexAg1 asks, when estimating the future rate of return into retirement calculations for those in the messy middle, should we use a more conservative rate given the market outlook?
Okay, cool. So what was the name?
Oh, TexAg1?
Texad.
TEXAG1.
Old Tex.
All Tex. So, all right. So Tex has asked this question. I'm in the messy middle. I'm in my 30s. And I'm trying to figure out how to project stuff into the future. And I'm trying to figure out, should I be more conservative given what's going on right now? You've asked two questions, but we're going to answer it in sort of in one, right? Should right now what's taking place, what's going on in the world affect the projections that you use? I don't think so, right? Because this is a moment in time, and we have good markets, we have bad markets, we have high inflation, we have low inflation, we have bulls, we have bears, we have all of the above. And if you're in your 30s, you're going to see a lot of these over your working career, over your investing career. Having said that, Brian, when it comes to projections and when it comes to measuring ourselves and when it comes to planning out, is it prudent to, on purpose, be conservative in those assumptions?
I mean, you're asking a question to a CPA. And there's a reason we get such great insurance rates is because we think about things in very conservative. Make sure you don't have to make hard decisions later because you weren't too overzealous with your assumptions. So I think, yes, whenever you're doing any long-term planning, you should be conservative with your assumptions. Remember, when I create any business, I usually come up with 3 business plans. I come up with what I think will happen. I come up with, oh my goodness, we're going to be rich. And then I always come up with, whew, this thing's rough. Mm-hmm. It's breaking down. And even on that assumption where I think this is what I think will happen, I'm always conservative with those assumptions because it makes sense to go into this with those conservative assumptions so you don't have to recalibrate and be disappointed later. It's always better to kind of under-promise, over-deliver, even to yourself. I mean, that's a great service model for anybody out there in the service industry, but it's also a great way to do planning for yourself. So I always do encourage people to be very conservative in their assumptions. I do love when we did the Know Your Number course and tool, we actually gave the ability for people to be conservative or aggressive or what we think will happen, kind of doing that 3-tier structure right within the plan. So within a flip of a drop down within the spreadsheet, it actually lets you kind of run all 3 of those scenarios. Now, I did want to mention for the part of building that great big beautiful tomorrow that when people, you need to understand something about markets. Every year, Vanguard comes out with their assumption of what they think the market's going to yield over the next 10 years. And I mean, they've been saying like 3% for really the last decade, 3.5%. And they always have some new reason. People, you guys always send me that article, and I appreciate you sending me that article, but I know it's coming. But here's something I need everybody to understand about the silver lining when we have market fluctuations like we have right now. Because you said, because things are down right now, should I make it more conservative? The reality, I want you to be conservative because that makes the plan better and ensures success. But the reality is, markets like now, because you're referencing we're in a bear market, markets are down over 20%, that actually increases the potential for your return over the long term. Because when you say the term buy low, sell high, when do you think buying low is? It's when everybody else is like, oh,
running for the exits.
There's no way I would buy into a stock market that's down 20% because you put money. I have a neighbor, a friend, hooked them up, setting up their first investment. Then we came up with this plan that we're going to do every month. And then, of course, the Monday after we buy, the week after the market has lost 5 to 6%, saw him again this weekend.
He's like, what's going on with this market?
No, he told me he cut off the monthly investment.
No.
Cut off the monthly investment. And that breaks my heart. The educator inside of me, the financial mutant inside of me, knowing, because when I look at my portfolio, and when you do the tax lot analysis, and you say, what were the best performing shares I've ever purchased? That 2008 to 2009 are some of the sweetest returns but do you think when I was experiencing, October of 2008 or even November of 2008 or March of 2009, I was thinking, man, this is the greatest time in the world to invest. No, I was like holding my nose and letting it happen, just letting that automatic wealth building occur. But when I look back on it, 10, 15 years in the future, I'm like, hot diggity dog. And that's the cool thing about investing is right now, all these shares that are getting beat up and compressed when you're doing your automatic monthly investment, they're going to be some of your best long-term performance. So you might be surprised to find out you actually get a much better rate of return on these dollars than what you anticipated just because of what's going on in the market.
Can I say just 2 more things on this about being conservative in your planning? We know that we as humans are behavioral creatures. The majority of the decisions we make are driven behind our emotions and our behavior. One of the things I love about being conservative is it gives me an opportunity for things to turn out better than I expected. So I can put down what I think I'm going to save this year. But when I actually go look back and say, okay, how much did I save that year? Where is my portfolio? What am I doing? When I know that I've surpassed my expectations, it gets me excited. It gives me this euphoric feeling of, oh man, I am exceeding expectations. I'm doing better than I thought. But it also keeps me motivated. It's one of the reasons on my net worth statement, I value my real estate property at cost. Instead of allowing the picture to look better, I want to stay conservative because it's going to keep me motivated to keep making really good, sound decisions over the long term. So I personally, especially for young folks, I don't think we should feel too comfortable too early because now is not the time for us to take our foot off of the gas. We will have the opportunity to do that later. Right now, be conservative and let things turn out better than you think that they will.
Very good, Bo.
Money guy, out. He just knocked over the desk. Oh man, you gotta move your chair. Oh, the desk is tilted. Hold on. There we go.
What is going on right now?
You can't make this stuff up.
Wow.
All right, Reeves, let's answer another question.
This is a very fun show to be watching live. You ready to do a question, Bo?
I'm ready to do a question.
Just so you know, people in the chat think that you look like Michael Barnes from Karate Kid 3.
I wish I could pull it up on screen. I don't. From Karate Kid 3, Michael Barnes.
Yeah,
I'll have to look
apparently
that up
he's
after
the
show.
villain.
Oh, well, that's messed up, guys.
I thought you should know. All right, but let's go to another question. Never a Dull Moment asks, when you are changing jobs, specifically in a bearish market, should you leave your 401k alone until it comes back to what you put in originally, or should you roll it over into an IRA or a new employer 401k?
Yeah, so that's a great, this never dull moment. That's a really great question. So a lot of people ask, all right, hey, I left a job, I had a retirement plan at a previous job. What should I do moving forward? And generally there are 3 options. Now, you notice I'm going to say 3, not 4. There are 3 options when it comes to what to do. One of the options is not cash it out. And too many people do that. They end up leaving a job and they say, you know what, I just had a few $1,000s there. I'm going to cash it out. I don't care if I pay taxes. I don't care if I pay a penalty. I just want the money. That is like off the table. Don't do that. No way, no how. Don't do that. So get that out of your mind. The first option is you can leave it behind at the old place. And one of the benefits of that, if you have a 401k that had really good low-cost investment options, had a diversified bucket of options to choose from, that may not be a bad option. The problem is in order to get access to the account, in order to be able to do anything in the account, you might have to work through your old company's HR. You might have to go work through the 401k provider who you no longer have a relationship with. So you need to make sure you measure that in terms of your analysis. The second thing you could do is you could roll the old 401k or the old retirement account into your current provider. Now again, you want to make sure that it has good, well-diversified, low-cost options, and it's justifiable to do that. There are a lot of times we'll see somebody leave a Fortune 100, really good, low-cost, fidelity-type retirement plan, and they might go to a startup, and the startup might not have a great retirement plan. It might have really expensive investment options, or it might be at not a super awesome provider like a Fidelity or Vanguard. And so a lot of times it makes sense to leave that 401k behind at the old provider and not roll it into the new provider. But now you're going to have different money in different places. You want to make sure it's still working on the same place. The third option you could do is you always have the option when you leave an employer is you can roll your old retirement account, your old 401k, old 403b into an IRA rollover at a custodian you choose. So you can go open up a Fidelity account, Vanguard account, Charles Schwab account, and you can roll pre-tax dollars into an IRA rollover pre-tax or Roth dollars into a Roth IRA. Well, then when you do that, you're not paying a record keeper. You're not paying a third-party administrator. You have a fully diverse option, a fully diverse menu of investment options that you can invest in, and you get to be the one in charge and in control of those dollars. Now, the problem with doing that is, one, the onus falls on you to select your investments, and so now you have access to the entire investment world, which maybe that's a good thing, or maybe it's not a good thing. And then the other thing is if you're someone who's doing some sort of strategy like a backdoor Roth IRA, by rolling those dollars into an IRA rollover, you now lose your ability to be able to do backdoors. So the question being, should I leave the 401k behind, or should I roll it to a rollover, or should I roll it to an IRA? Depends on your unique circumstance and how good each of those 3 options are. It's not uncommon. We'll see someone who changes jobs a number of times, and one time we might leave it behind, and the next time we might say, oh, this is a really good one. Let's roll all the old 401ks in. And then they might change jobs again. We'll say, oof, now let's roll it into an IRA rollover. It's not the exact same decision every time. Every single time you have to work through the metrics to determine what is the best decision.
Bo, I'm so excited when you give answers that I don't even have to add anything to. Well done.
Fantastic answer. All right, let's do a few more questions. We're going to move on to Sean's question. He says, based on the FOO, when do interest rates go from a percentage that's considered low interest, which is step 9, to high interest, which is step 3? What percentages should I be concerned about? For example, would 7% be considered high interest?
This is a great question. But why don't you walk them through when we were trying to when we were crafting the financial order of operations, there came this inclusion of risk-free rate of return, and how that there's always going to be risk-free rate of return, but there's also a premium for investing, and how that went into this whole decision.
Yeah, when it comes to low interest versus high interest, it's a little bit subjective. But before I talk about the subjective nature of that, I also think it's important to mention the types of debt you carry matter. And what I mean by that is debt on credit cards are different than debts on businesses that you own, or debts on a home. And debts on a business appreciable asset that you own is different than debt on a depreciable asset like cars. So even though interest rates can be applied to all the different debts, not all debt is created equal. That's sort of the first baseline we have to lay out. So then it becomes, okay, well, how do we determine what is low interest versus what is high interest? The way that we arrived at that academically is by figuring out, for your age, for where you are, what is your equity risk premium? Meaning, if you were to take those dollars and go invest elsewhere, and you were going to go put those dollars to work, what would you expect to be compensated for taking that risk? All of us can go out right now and go get the risk-free rate. We can go put our money in a cash, CD, treasury bill, fill in the blank, and we can get the risk-free rate. Some of us can then take those dollars and go deploy them elsewhere, and if we take on more risk, we are expected to receive a greater rate of return. Well, generally speaking, as we age, as we get older, as we move closer towards financial independence, as we move closer towards needing our dollars, the equity risk premium that we can expect to make on our dollars decreases. What that means in very plain layman's terms is that high interest debt for someone in their 20s is likely very different than high interest debt for someone in their 50s.
So let's actually talk about this a little bit, because we've seen this play out with student loans. You could probably look at this for mortgages, even though, remember, there's elements like deductibility of the interest and so forth that comes into play. But I think, I've always told people, I don't want you really thinking about prepaying that low interest mortgage until it's step 9, and typically it's going to happen when you're 45 and above. Yep. And why is that? Is because from ages 20 to 45, you're at the peak multiplier effect.
Your dollar's got some juice.
I mean, you got a lot of benefit because you have time on your side. The compounding is really working for you. But let's take the example of what Bo just talked about. The risk-free rate of return right now, if you go look at the 10-year Treasury, it's over 3.5%. And I'm just going to grab 3.5%. I think it's 3.6, 3.7, depending upon what's going on. But we're just going to say 3.5%. For a 20-something, you probably would think that because they're aggressive, because they have decades ahead of them in the future, you could put a risk premium on that of about 4%. Sure. So, I mean, it very
maybe
easily.
Even more, yeah.
Well, because as interest rates go up, that risk-free rate of returns, probably the Treasury is going to go up as well. So right now, I mean, looking at that example, a 20-something probably isn't going to cross that threshold until over 7.5%. But, a person in their 40s or 50s, they're not going to want to have a spread of 4%, because they know that they're going to use more asset allocation. They're going to be more conservative because they got retirement on the horizon. So it might be possible that at that point, maybe the number is 5.5 to 6%. Sure. And that's why I think it frees you to where if you're a 40-something, especially your late 40s, hopefully you've made it through. You're at step 9 of the financial order of operations. Go attack that debt. Pay it down, because it's not about, because there's two parts of this equation. There is getting wealthy, and then there's keeping wealth. And what's interesting is while you're young, there's a big question mark on will you be wealthy?
That's right.
But if you've done everything while you're younger, the maximization strategy shifts to, hey, we've done the right things. We've created wealth. We've created independence to a degree. So we need to make sure we keep it, because it's not guaranteed that you'll keep it. And that's why you do see the risk analysis shift. In the beginning, the risk is you're not going to be wealthy because you didn't put enough money to work. As you get older, it's now the risk model says, hey, how do we keep what we've built? That's what all this is structured off of. So I think, Sean, I love it when we get to do these nerdy questions, because, by the way, that's not how this is. This is designed for you to go to moneyguy.com/resources, just download the resources, or you can go to learn.moneyguy.com and actually get the course. we've made it where it's digestible. We don't have to get into all this nerdy stuff, but I know a lot of you guys you're the money maximizers, you're the accountants, you're the pilots, you're the engineers. You want to know how stuff works. And I love that I actually get to show you that our fingerprints really did try to think about things not only from what's successful for you in an easy to digest format, but also what has the nuts and bolts of true theory built into it so that this thing will serve you no matter where you are in the financial journey.
And I want to remind you guys, this year, if you're listening to this in 2022, is one single year. When we talk about equity risk premiums, we're talking about the rate of return you expect you can earn over a longer period of time. So like, yeah, the market's down this year, so you can make the funny joke about, oh, well, I'm not making any money this year. Stretch it out. That's why one of the things, if you're a client of mine, and we've had a meeting recently, I've said, look, here's what's going on in your portfolio year to date. But look at what happens when we stretch that out for the past 3 years, the past 5 years, the past 10 years. You can see that over the long term, individual years seem sporadic and there's no rhyme or reason to it. But when you start putting those years together over a long time horizon in a risk-adjusted, well-diversified portfolio, the numbers actually start looking pretty darn good. And I think most of our seasoned investors out there in the chat would agree with that. Yeah, 2022 is not great. But man, if you look at what I've done since 2015, still looks pretty darn good.
Awesome. Great answer. Let's move on and talk about the 3-bucket strategy. Addison says, Money Guy recommends the 3-bucket strategy, but does that change for those who might not ever reach 25% savings in accessible tax advantage accounts? Should some people consider a taxable account to even things out? What do you think?
So for those of you who aren't familiar, we have this idea called the 3-bucket strategy. When you get to retirement, or when you get to financial independence, we want you to have 3 distinct buckets of assets. We want you to have tax-deferred assets, that's like 401ks, IRAs, pre-tax assets. We want you to have tax-free assets, that's your Roth and your HSA, and then we want you to have after-tax or currently taxable assets. That's like just your regular brokerage account, regular individual account. And the premise behind that is that when you get to financial independence and when you start living off of your dollars, no matter the tax policy in place, you can control your tax situation. So in a low tax environment, you can pull money out of the pre-tax assets. Or if we are in a progressive tax system, you can pull money out at the lower tax brackets. And then as you need more income, you can pull off of your taxable assets, or you can even pull off of the tax-free assets. You get to control what you pay in taxes. It's not uncommon. We have clients, large 7 to 8 figure portfolios, living off of 6-figure incomes, still paying in the lower tax brackets because we're able to tax manage their portfolio. And so Addison's saying, well, if I'm never high income and I'm have the ability to stay below the 25% bracket, do I really need all 3 buckets? I mean, am I really gonna have even that pre-tax bucket? Is that something I should focus on? Or if I'm not quite at 25, are there ever times when I should not max out my employer-sponsored plan and start building an after-tax account, start building up that 3rd bucket? So how would you answer those 2 questions?
I heard the question a little differently, but I think that this will still play out well, is that step 6 of the financial order of operations is max out retirement. And I think that's where I thought maybe Addison was thinking, hey, if I'm never going to go past step 6 to get to step 7 for where the 3 buckets lie, am I doing this wrong? And I always have to remind people, because Bo and I, in the early stages of the financial order of operations development, we were giving a presentation on this to a bunch of engineers. And one of them raised their hand and goes, hey, I just think it's cruel that I'm saving all this money, but I'm not going to get to, I don't have enough income coming in to where I'm going to fund my kids' college and everything else. And so I wanted to make sure I clarified, even if you don't make a huge income, meaning 6 figures and above, you can graduate from step 6 to step 7 by just exceeding 25% of your gross income working for you, meaning you're saving and investing 25% of your gross income. You will get to step 7. And that's an aspirational thing that I think will happen. If it doesn't happen in your 20s, I think it could happen in your 30s, no matter where your income is. I'm hoping you're structuring through a disciplined life that you can get to step 7. But if you don't, if you're a person that, you're struggling and you're only able to save and invest 15%, you never get to step 7, you're still going to have tax-free money. That Roth money, that bucket's probably getting filled up. That's going to give you a tremendous retirement option, just because there's all that tax-free growth that's out there. More than likely you do have after-tax money both in steps 1 and 4 with your emergency reserves. So that's going to serve you. And plus, if you never get to the point where you exceed step 6, you're probably, I mean, if you're, because wealth is relative. If you're a person that lives off 50 grand a year, or 40 to 50 grand, getting close to $1 million is going to do a lot for you.
Sure.
Especially when you take into account Social Security and other things that come your way, you're relying close enough to the social safety net that you're going to be fine. A little goes, $1 million is going to do a tremendous sum for you. But if you're a person that through your working career, you're making $200,000, the obligation falls much more that you better have a big chunk of money out there working for you. So wealth is very relative. If you know what you spend and what you need, that's why we created Know Your Number.
Yeah,
I mean,
right.
if one of the things, if you go to learn.moneyguy.com, we have a tool that will help you try to figure out, how do I take all this into account so that I can better shoot for understanding how much money I need? And then you can kind of figure out, how does that all shape out with the financial order of operations? I don't know, because it sounds like you heard that a little differently than I did.
And the only thing I'd say is the FOO is supposed to be guardrails, right? The FOO is supposed to be general ideas to get you moving in the right direction. But your unique financial situation may dictate something different, specifically as you get towards retirement. That's why, again, when people become clients of our firm, one of the things our advisory team does is they do a FOO for you. Like your unique and specific financial order operations based on what you have going on. The FOO are guidelines to get you moving in the right direction. But let me go ahead and tell you, if you build $3 million and it is all in a pre-tax 401k and you need to live off of 40 grand a year, you're probably going to be okay. You don't have 3 buckets, but that pre-tax bucket, now you may not have control over your tax situation. You may not have enough flexibility, but you've still done a great job saving. If you get all the way to financial independence and all you have is the tax-free and the taxable bucket, you're probably going to be okay. Do you have enough money? Do you know your number? Did you hit the number? And will that pot of money be able to provide for you for the rest of your life? The FOO is just a maximization strategy on the path to get there, but your actual circumstance will dictate what makes the most sense in your unique situation.
Great answer, Addison. Hopefully that helps you out. If you are interested in checking out the FOO, you can download it for free at moneyguy.com/resources or jump into the full deep dive in our course at learn.moneyguy.com. Okay, Garrett has a question. If you have an unexpected expense that reduces your emergency fund, would you reduce your retirement contributions to increase cash flow, sell your brokerage assets, or just wait until you can build up your emergency fund over time? And so for some additional context, here's why he's asking. He's 31 years old. He's maxing out his Roth 401k, doing backdoor Roth, doing mega backdoor Roth, and he's trying to decide, should he temporarily back down the retirement, or should he sell some of his brokerage funds, or what should he do? What do you guys think?
See, Garrett gave us too much context. We know too much about him now, right? Because he just told us that he's maxing out his 401k and he's maxing out mega backdoor. Is that what you said?
He did say mega backdoor Roth.
So, and Garrett didn't give us his income, did he?
He did not.
So what I'm guessing, Garrett, is if you're maxing out 401k and if you're maxing out mega backdoor, unless you have a super high income, which you may, I bet your savings rate is through the roof. I bet you are well beyond the 20 to 25% threshold. You get that vibe, right?
I think he makes a good income. Anybody who can do the backdoor Roth and max it out, you usually have to have a decent income.
So do you think his savings rate is just the 20, 25%, or you think he's got more of the savings rate there?
I think he's probably already over it.
Okay.
If I had to base, but I mean, I'm playing the whole, back into it through deduction, and I deduced that is that even a word? Did I?
Deduce is a word. Yeah, it's a word.
But I've come to the point that I think he has more. Here's what I would think. Remember when we talk about emergency reserves, we say 3 to 6 months. Mm-hmm. You need to think about, because as I've made it through the financial order of operations, my emergency reserves actually expanded. because now I actually have, in addition to saving and investing 25%, I wanted extra cash because I have businesses, I have other things, and I wanted opportunity money in case more real estate or something else comes along. So I would ask Garrett first, how lean is he cutting that emergency reserves? But where an unexpected expense is now side railing because maybe there needs to be the first step on this analysis is, hey, should we recalibrate what the emergency reserves in step 4 of the financial order of operations is? Because I know it sounds like Garrett has tried to maximize the wealth building, which is very important. I'm all for it, especially if he's young. I think he said 31, so he is young, so he's got a lot of opportunity there. I love that he has really loaded up, so he's probably crushing all the tax-free accounts by doing the mega Roth conversion and all those other things. But if you've run it so lean that one unexpected thing is causing you to not have enough, I think a little more work probably is needed on 4 to make sure that number is right to reflect your life. Because I don't want you running it so lean that your emergency reserves is getting crushed anytime any life event happens.
But even in that, so let's say that it was fine. Let's say it was 4 or 5 months of expenses, but then he had to use it. He's asking, how do I replenish it? What are the things I should do? Should I stop saving as much for retirement? Should I sell brokerage assets, or should I just fly naked while I build it back up?
Well, I'm not an all or nothing type person. If I'm somebody who, yes, maybe I had a big thing come out, like you bought a new car or you had a big medical expense that, was unforeseen, and it was something that's you don't count on this happening every year. This is something that happens once every 5 years, or you have time to plan ahead. Then it's just like when I get stuck with an absolute question, I usually try to figure out, is there a way I can navigate both? Because I don't want you just to shut down a lot of your retirement savings. I don't think you have to, because at the savings rate you're doing. But it does mean that maybe you recalibrate and you say, hey, over the next 12 to 18 months, or maybe 9 months, you figure out what fits, how big of a need is this, how big of a hole in your emergency reserves is, and then how long are you comfortable with that risk? Because remember, emergency reserves is supposed to keep your financial life out of the ditch. So you want to be conservative with this. So if you're one of those people, maybe it's 3 months or 6 months, but there's nothing wrong with saying, okay, maybe I can dial down just a little off the retirement. So I'm still getting a lot of the benefit. I'm not stealing or taking away from my future self, but I am replenishing, but in a very calculated period of time so that I'm going to come out. Because you should be scared. If you're breaking the rules and your emergency reserves are below where they should be, you should have a little bit of fear. But I don't know that I would just shut it all down and say, okay, 100% needs to go back to emergency reserves to fill the bucket back up, because there might be a gray zone there where you have the chance to fill this back in over 6 to 9 months and still keep working. I wouldn't know without knowing more details.
I agree with what you said, but I also disagree with what you said a little bit. I'd do it faster. I really would. I really would do it faster, because I think that emergency reserves have to be there. Now,
they do.
Here's what I would not do. I would not forego employer match. I would not forego like tax-free opportunities because you have a limited window on that. But if I had to back down my savings rate for a month, 2 months to really get that emergency reserve back to where it needs to be, I think that's just like risk management 101. I wouldn't shut it all down. I agree with you there. And I wouldn't sell brokerage assets either, because the emergency has not happened yet. Well, brokerage assets, we know we're down 30% right now. I don't know that I want to lock in that 30% loss and just have that go to my emergency, because I can still get to those assets if I need them. I personally would probably back down my savings, build up my cash, and then jack my savings back up.
I think, context is important here. If you ran it down so lean that you're within a month of living expenses, yeah, you probably need to hit pause, go fill the buckets up. But say you run it 6 months and you're down to 4 months.
Yeah, that one's
you have some,
okay.
You're not running yourself naked here. You're actually, you got some extra space there. So that's the context that's probably needed in this decision too, is how much was this thing that derailed? Is it a minor inconvenience, or did you really have something come your way? Maybe it was a business opportunity, maybe it was a new car purchase, and you got yourself swimming naked a little bit. Yeah, you got to recalibrate in a heavy way to get that 1 month brought back up to the 4 to 6 months that's comfortable. But maybe this was a little hiccup that took you from 6 months to 4 months. I'm going to give you a little more grace that maybe you don't have to do an all stop, and you can still keep throwing some fuel on the fire that's building financial independence in the long term.
Awesome answer. Thanks so much for your question. Let's move on to Cody's question. He says, if I am hitting 25% savings in my Roth 401k, does it matter that I'm not putting anything into a Roth IRA? Or should I be taking some advantage of some type of IRA? What do you guys think?
This is a question as old as time. What's better? Roth IRA or Roth? At the end of the day, that's what he's asking.
Competition.
Yeah,
What's
right.
better, Roth IRA, Roth 401k? Brian, what are the differences? What's the difference in a Roth IRA? What's the difference in a Roth 401k? How do I know when it makes sense to do which one? And Cody, I'm just going to cut to the end, and our answers do both.
Yeah.
So I gave you the answer. Now, here's all the context. What's the difference and how do you know which one to do?
The Roth IRA, the reason, step 5 is just focus on Roth. And we talked about Roth and HSAs because they're tax-free. That's the tax-free growth opportunity is the big thing. Now, the vehicle that you use, we like Roth IRAs in the fact that you control it completely and the fact that you can do your research by listening here and hey, it's important that I do a low-cost provider, that I have good investment choices, and you get to choose and control 100% of that because you know what our thoughts are towards that. The employer plan could be good, it could be bad. You don't know because you have to love the one you're with your employer because you didn't get to make that decision. Your employer got to make that decision. Now look, a lot of you work for employers that have taken this responsibility very serious, and they have teamed up with a lot of the providers that we talk about, the Vanguards, the Charles Schwabs, the Fidelity Investments that have those low-cost index funds. And you might find that your 401k is actually with a provider that you would have personally chosen with your Roth IRA. And in those situations, Cody, I think that it's more of a neutral stance at that point that, yes, okay, I get it. If you only have so many dollars you can invest, even though Bo wants you to do both, if you only have so many dollars that you can invest, if the Roth 401k is the exact same provider you would have probably chosen for yourself because your employer took it serious and you like that you get some of that ERISA protection and all the other benefits that come with qualified assets like that, then I don't see a problem with it. But that's not always the case. Once again, all things financial planning, this is why we'll never be replaced with robots, is because there's so much that goes into your personal situation. And that's why I love that we get to do the Q&A, answer questions, because we get to kind of give you the flavors that really mix things up and gives you the decision factors we do as personal financial planners.
2 caveats I'll throw in there. These are just really small things. With a Roth 401k, there's a chance that there are going to be fees associated with that. Your employer has to pay for a third-party administrator and a record keeper. So there's a chance the Roth IRA might be a little slightly less expensive than the Roth 401k, depending on the fees that you're paying to each one of them. That's number 1. Number 2, Roth IRAs are not subject to required minimum distributions at age 72. Roth 401ks are subject. So what do you do before you get there? You roll the Roth 401k into the Roth IRA. That's just 2 distinctions between the two that you ought to know about. I think you should do both of them and really just jack up that tax-free bucket.
Awesome. Hopefully that gives you some context, Cody, as you kind of think through that decision. Thank you so much, everybody, for your questions. We love breaking it down and just giving you this free advice. We love being here. Thank you so much. And remember, if you want to go deeper, we do have that brand new course for pre-order right now. It's called Know Your Number. It's going to help you lock in what your retirement number is and even figure out ways to get there faster and if it's feasible and factor in all of your like lifestyle, retirement age, rate of return. I could go on, but go to learn.moneyguy.com and check that out. You can get 20% off right now through October 11th by using the code COUNTDOWN at checkout.
That's what I was waiting for. Give them that code.
I know.
Our
I gave
financial
them the
meetings
code that
like
time,
a deal.
Brian.
So load them up. And by the way, if you haven't checked out, we have tons of free deliverables. Moneyguy.com/resources. And of course, exactly what Reby was talking about. Go to learn.moneyguy.com. Check out all the things that are designed to accelerate your success so that we can get you to graduate through the abundance cycle as fast as possible. I'm your host, Brian Preston. Mr. Bo Hansen, Money Guy team, out.